Welcome to RealCast, the weekly roundup of the real asset markets. I'm joined this week by Dan Innes and Nicole Dines. Nicole, let's start with you. What have you been following over the week?
Real Asset Media had a briefing on the outlook for Germany, and from data that Inga Schwarz of BNP Paribas Real Estate gave, the UK in 2021 regained its top position that they had lost to Germany, and Germany has gone back to second place. But significantly, as she pointed out, the UK's performance has been below the five-year average, while Germany is well above its five-year average. So as she put it, Germany is very much in a different league this year, and prospects are very positive. The office sector is still incredibly strong despite all the doubts about working from home. It accounted for almost half of all commercial deals in 2021, 30.7 billion euros, 48% market share. And logistics had its strongest year ever. That's not a surprise. And hotels investments in making a good comeback, and also in retail. While high street retail hasn't done well in Germany, some aspects of retail, such as grocery anchored retail and retail parks, are doing very well and are attracting investor interest. In general, as I said, Germany is set to do well, and its status as a safe haven is set to be very good in these sort of very uncertain times. And last year there was then the pandemic and uncertainty over the future of the country, with Angela Merkel stepping down. While this year, as Carsten Loll of Linklaters pointed out, we have a coalition government in place, which is very stable. And as he put it, the government takes the economy very seriously, and it reflects different viewpoints. So it's very good news for Germany. So international investors last year were deterred, obviously, by the travel restrictions. So 61% of deals were done by German investors, only 39% by foreign, and most of them were Europeans, reflecting the difficulties, obviously, in getting to Germany. But this year, things are expected to change, and so foreign investors will come back. And we know that the residential sector has always been strong in Germany, but last year it was off the scale. Transactions volumes more than doubled to 51 billion euros, partly due to one mega deal, the Vonovia takeover by Deutsche Wohnen, which alone was worth over 22 billion euros. But still, there's a big trend, and also things are becoming more expensive. Last year, 81% of transactions in the residential sector were above the 100 million euro mark. So that, and Berlin in this case is the star of the show in real estate in general, but especially in the residential sector. And as Markus Baron of Berlin Hip said, he called it the investment El Dorado. It attracted last year over 11 billion euros in investment. That's more than entire countries like Spain and Italy. So that's quite remarkable. And finally regaining its status as a sort of European capital, it was pointed out. But the A cities in Germany in general are doing really well. Munich attracted 7.7 billion, which again is more investment than Poland or Denmark. So German cities are expected to do well this year. They continue doing well. The big topic across Germany, as indeed it is across Europe, is ESG, the greening of portfolios. And almost the entire stock has to be upgraded in the residential sector as well. Already investors are taking notice, and the new data show that there's an uptake in investor interest, and over 25% of new deals now regarding green buildings, showing that investors are being very selective and will become even more so. And interestingly, banks are beginning to finance the transition, because obviously who's going to pay for this? And Baron of Berlin Hip said that that's one of their main areas of focus now. They're preparing transformational loans to facilitate the transition to green buildings and to encourage investors to repurpose their stock.
Yeah, I thought it was interesting as well, that discussion around Berlin and if it has the potential to grow to compete with London and Paris. Also, a lot of activity in the logistics markets this week, with Patrizia buying 2 logistics assets in Germany, LaSalle buying Last Mile in Verona, and a major announcement in terms of Blackstone recapitalizing Mileway to the tune of $21 billion. Mileway's CEO, Emmanuel van der Stichler, saying Blackstone's ongoing support will enable us to continue executing our shared vision for Mileway. So major capital investment into the logistics sector. We also published some interviews with Ben Sagelman of DHL on that logistics topic, and very interesting to see there the focus both on the availability of workers driving location choices and the huge focus on sustainability. So again, 2 of those big themes coming through in terms of the sector. Dan, what have you been following?
Yeah, quite a few things. On that logistics theme, yeah, Ardent UK, they've acquired two more light industrial assets in North London and in Yorkshire for a total of 21.3 million. And that brings Ardent's UK industrial portfolio to over 2 million square feet. Elsewhere, Legal & General, they announced it's planning to invest a further £2.5 billion of pension money into the UK build-to-rent market over the next 5 years, with its retirement institutional business expecting to create more than 7,000 new homes. You'll remember L&G was an early entrant into that build-to-rent sector when development initially focused on London and targeted sort of above market rate rents. But last year, its retirement institutional business invested over £500 million on the development of 4 build-to-rent schemes. And as we've been reporting here on RealCast, as more institutional capital has targeted rental housing over the last few years, development has kind of fanned out to UK regional cities where yields tend to be higher. Meanwhile, one of the biggest deals that the retail world has been following is the bidding on the vast Boots pharmacy chain and portfolio. And that's been given until the end of the month to lodge first round bids in what looks like it'll be around £7 billion, where interested parties include potentially one of the new owners of Asda and a clutch of the world's largest private equity firms. But it's understood that Boots have been meeting up with bidders already alongside Goldman Sachs, their advisors this week. And from pharmacy to grocery, Ocado's results came out this week, and they included a new joint venture with partner Group Casino in France. That means it's going to be able to offer its technology to other grocers in France as well, which is a loosening of its original agreement. It's also going to be able to pick from the group stores, including its in-store fulfillment solution across other of its Monoprix stores across France. That venture kind of releases Ocado from its previous exclusivity agreement, as I mentioned, but it allows it to explore other partnership opportunities to include its software to retailers across France for the first time. In the background, revenues at Ocado's technology division, which provides automated fulfillment centers and warehouses for its supermarket chains around the world, those revenues rose from 16.6 million last year to 66.6 million pounds this year. So they've been investing heavily in its platform and its robotically serviced warehouses. And last couple of points, WH Smith, they've launched its first checkout-free store located in New York's LaGuardia Airport using Amazon's Just Walk Out technology. That's the same, we're getting used to it in London here, but users simply have to tap their credit card to enter before picking up what they want and just walking out. But that news obviously is in the same week as Amazon and Visa reached their agreement over their fee dispute. But lastly, just as we're thinking about our summer holidays, Richard, the Hilton Worldwide Holdings company beat analyst expectations this week, reporting that revenues had gone up 106% in Q4. Revenues rise up to $1.84 billion compared to $890 million for the previous year. And that's been that's accountable because of vaccination uptake and a return in people traveling over the Christmas period, helped to boost hotel occupancy rates in that fourth quarter.
Yeah, very interesting to watch both the retail and hotel and leisure markets seeing some recovery in this early part of 2022. Thank you, Dan. Thank you, Nicole. Thank you for watching us, and look forward to seeing you next week for our regular roundup of the real asset markets.